So imagine convincing your core customers, right, to just happily pay a 10% premium on your flagship product.
Oh, I mean, that is the absolute dream for any retailer.
Right. And you grow your sales volume by almost 5%. And this is in the middle of a tightening macro economy.
Which is incredibly hard to pull off.
It is. You execute your merchandising strategy just flawlessly. And then at the end of the quarter, you look at the books and you realize you actually made less money than you did a year ago.
Yeah. It's a complete mathematical nightmare.
It is a nightmare. And that is the exact situation the Buckle is facing today. It is just a fascinating window into the current state of consumer spending.
It really is the ultimate retail paradox.
Yeah.
Because you can do almost everything right on the actual sales floor.
Yeah.
But if the structural costs of running the business, if those are accelerating faster than your pricing power, the net result is a margin squeeze.
And we are seeing that squeeze happen in real time today. So we are executing our Talk Tickers mission right now, breaking down the freshly released Q2 2026 earnings call transcript from the mall retail staple, Buckle.
Ticker symbol BKE.
Exactly, BKE. And look, our mission on this deep dive is to cut through the Wall Street fluff, right?
Right. Skip the jargon.
Get straight to what retail investors actually need. So we're talking data-forward insights, plain language translations, and a clear, actionable verdict on what this means for the stock. And we usually try to do this in under 5 minutes.
Though we might get a little carried away today because there's a lot to unpack here.
We always get carried away, but the goal is the same, right? Actionable and fast.
Definitely. And Buckle's Q2 is it's the perfect case study for the 2026 mall environment.
Why is that?
Well, I mean, we are looking at a company that is navigating really intense shifts in fashion cycles, plus an incredibly fractured consumer base.
Yeah.
And then on top of all that, you have this rising floor of operating expenses. So it's basically a masterclass in the absolute limits of pricing power.
Okay, so let's get into the headline numbers right out of the gate, because the disconnect between the top line and the bottom line here is it's jarring.
It really is.
So for the 13-week second quarter, this ended August 1st, 2026, Buckle's net sales hit $319.8 million.
Okay.
Which is a very solid 4.6% increase year over year. And their comparable store sales, so organic growth, those were up 2.1%.
And online ticked up too, right?
Yeah, online sales ticked up 2.3%. So the revenue engine is definitively humming along.
Yeah, I mean, a 2.1% comp in this particular discretionary retail environment, that's a massive win.
Right, because people aren't exactly throwing money around.
Exactly. It shows that their existing footprint is highly productive. Management is getting more actual dollars out of the exact same square footage.
Which is what you want to see.
Right. And when you pair that with nearly 5% total top line growth, the initial read is incredibly bullish. I mean, they are capturing market share.
Right. But then we hit the EPS.
Right. The bottom line.
The bottom line. Net income actually dropped to $44.4 million.
Yeah.
So that comes in at 87 cents per diluted share.
Down from what, 89?
Down from 89 cents in the exact same quarter last year. So it's like getting a 5% raise at your job, right? But then you realize your actual take-home pay is lower because your commute got more expensive and your grocery costs went up.
That is a perfect analogy.
Yeah, it's like driving a car with a massive parachute attached to the back. Management has the accelerator pressed to the floor. They are growing revenue, the comps are up, traffic is converting.
But the aerodynamic drag, right, of their underlying costs means they are actually losing speed on the bottom line.
Exactly. So if sales are up almost 5%, where exactly is the profit leaking out?
Well, that aerodynamic drag is the defining narrative of this quarter. And to figure out where that drag is coming from, and conversely, was keeping that top line engine firing so hot, we have to look at the massive behavioral divide between their male and female shoppers.
Oh, this was wild to read.
It is essentially two completely different macroeconomies operating under the exact same roof.
The polarization is staggering. Let's look at the women's segment first, because they are single-handedly carrying the company right now.
The absolute star of the show.
Yeah. Women's business increased 9.5% year over year. And this segment has now crossed a pretty critical threshold.
Right, it's half the business now.
Exactly. It represents an even 50% of Buckle's total sales.
And we really have to contextualize that 9.5% growth, because they are comping that against an 18.5% increase from Q2 of 2025.
Oh, wow. So it's compounding.
Exactly. It's compounding multi-year growth in a discretionary category. You just do not see that very often right now.
Yeah. And the engine behind the specific growth is denim. Women's denim sales jumped 11%.
Right.
But here is the mechanism that should really make investors pay attention. They didn't just sell 11% more jeans by, aggressively discounting them.
No, the opposite, actually.
Right. The AUR, the average unit retail, for women's denim spiked from $85.35 to $92.50.
That's crazy.
This $7 price hike, and volume still went up 11%. That level of absolute price inelasticity in 2026 is almost unheard of for a middle-class mall retailer.
It really speaks to the mechanics of a major fashion cycle shift. I mean, we are entirely out of the skinny jean era that kind of dominated the 2010s.
Thank goodness.
Right. Well, management highlighted this massive growth in wider leg silhouettes, varying rises, just entirely new proportions.
Which explains the pricing power, right?
Yeah.
Because when a consumer replaces a worn-out pair of skinny jeans with another pair of skinny jeans, they are highly price sensitive.
Yeah, because it's just a utility purchase at that point.
Exactly. It's a utility purchase. But when the entire prevailing silhouette changes to a wide leg or a flare, the consumer's existing wardrobe breaks.
Right. Everything else looks wrong.
The tops they own don't lay right. The footwear proportions look completely off, so they are essentially forced into a total wardrobe refresh.
And it becomes an emotional, trend-driven purchase rather than just a utility replacement.
Right.
And when it's an emotional purchase, price resistance just completely melts away. It's like women are perfectly willing to pay premium steakhouse prices for the right wide leg fashion.
Premium steakhouse prices, exactly. And that structural wardrobe refresh is exactly what we're seeing in the data. Management explicitly called out a category they refer to as alternative pants.
Right, the non-denim stuff.
Yeah. And this segment exploded by nearly 50% year over year.
50%.
50% growth in a single clothing category. I mean, that is the kind of metric you usually only see in tech startups.
Yeah, not mature brick and mortar apparel.
Right. And it has driven by demand for prints, colors, and non-denim wide leg bottoms.
And to your earlier point about the existing wardrobe breaking, the women's tops category also grew 10.5%.
Oh, that makes perfect sense.
Yeah, management noted this was led by fashion and graphic styles that are specifically designed to pair with those wider leg bottoms.
So they aren't just selling a pair of pants. They are selling the solution to the new silhouette.
Exactly. It's a complete outfit strategy. And that actually extends to the kids department too, which is functioning as this highly lucrative add-on.
Right, the mini-me styling.
Yeah. Kids sales increased 11% this quarter. And that is built on top of a 23% increase last year.
Wow.
And management attributes this directly to, quote, mini-me styling. Basically, kids dressing like their parents.
The psychology there is just brilliant. Think about it. The female shopper is in the store. She is already willingly absorbing a higher AUR to update her own wardrobe for the new fashion cycle. And then the merchandising team places the exact same wide leg styles in miniature right in her path.
Yep. It capitalizes on the momentum of the primary purchase.
It drives up the average transaction value seamlessly.
It does. But, this incredible pricing power and this compounding growth on the women's side, it really makes the men's side of the store look even more concerning.
Oh man, it is night and day. You walk across the center aisle and the temperature in the room completely changes.
The men's segment is completely stagnant, like flat year over year.
It's dead in the water.
And men's denim sales actually declined by 3.5%.
And management didn't mince words about the mechanism driving this decline either. They explicitly pointed to, I think the quote was, softness concentrated in higher price point national brands.
Yeah. And this is a really profound signal regarding male consumer psychology right now.
How so?
Well, the female shopper is actively chasing a macro fashion cycle, right? She's absorbing price hikes to stay on trend. The male shopper is operating purely on utility and inflation fatigue.
Right. They are just tired of the prices.
Exactly. He walks in, he looks at a premium national brand of denim, sees the markup, and just actively rejects it. The price elasticity has completely snapped.
Men are actively balking at these expensive national brands and trading down.
Yeah. But they're still making purchases. They are just aggressively trading over.
Right, because management noted that their in-house private label denim significantly outperformed the overall category in men's.
Yep.
And because of this mass migration away from third-party national brands and toward Buckle's own proprietary labels, the average men's denim price point remained flat at $89.20.
So the male consumer has basically drawn a hard psychological line in the sand at $89.
Not a penny more.
Right. They are choosing brand anonymity over paying the freemium for a recognizable logo on their back pocket.
That is a very dangerous trend for the national vendors supplying Buckle.
Extremely dangerous, but it's actually a structural advantage for Buckle's gross margins, assuming they can maintain the overall volume.
Which they are struggling to do.
Yeah.
They did see a 3.5% growth in men's tops, though, right? Like graphic tees, short sleeve wovens, hoodies.
Right, but this feels like the classic consolation prize purchase.
Oh, totally. If the male shopper balks at a $110 pair of branded jeans, they assuage that shopping impulse by dropping $30 on a graphic tee.
Exactly. It satisfies the urge to buy something.
Right. It's a lower barrier to entry, but it heavily impacts the units per transaction and AUR metrics.
And we definitely see that in the transaction data. Units per transaction actually dropped by about 1% company-wide.
So people are literally taking fewer physical items to the register.
Yeah. However, because of the massive price hikes absorbed by the women's segment, company-wide AUR still increased by 4.5%.
Which pushed the total average transaction value up 3.5%. So every time that cash register opens, it's taking in more cash. So if the revenue is up and private label penetration is increasing, which we know carries a significantly higher initial markup, the gross margin should be expanding rapidly. Like, where did the profit go?
Well, it did expand, but the composition of that expansion is highly deceptive.
Okay, break that down.
So gross margin came in at 47.8%, which is a 40 basis point increase. And within that, management touted this massive 110 basis point improvement in merchandise margins.
Okay, in a vacuum, a 110 basis point jump in pure profitability is stellar.
Right, it sounds amazing. But in the Q&A, an analyst from UBS actually forced them to unpack that metric.
I love when they do that.
Right. And the reality was a lot less structural. Management admitted that 65 basis points of that merchandise margin improvement was a one-time benefit.
Wait, a one-time benefit from what?
From a $2.5 million government tariff refund.
You have got to be kidding me. A tariff refund?
Yes.
So Uncle Sam was basically their most profitable customer in Q2.
Exactly. Which means the actual organic improvement, the part driven by their private label mix and regular price selling, was only 45 basis points.
Wow. Okay, still positive, still a testament to good inventory management, but heavily padded by a retroactive check from the government.
Heavily padded. And they explicitly stated we shouldn't expect that windfall to repeat meaningfully in Q3.
Right. So if the merchandise margins are only organically up 45 basis points, it becomes incredibly clear why the net income dropped when we actually look at their SG&A.
Oh, yeah. The SG&A expense line is the parachute dragging down the car, in your analogy.
Right. The selling, general, and administrative expenses.
Yep. Operating expenses rose to 30.4% of net sales, and management broke the margin pressure down meticulously on the call.
What were the buckets?
It was 45 basis points from marketing, 35 basis points from store labor, 30 basis points from health insurance, and 20 basis points from store supplies.
Okay, so the labor and health insurance metrics, those are standard macro environment pressures right now.
Yeah, everybody is dealing with that.
Right. Retailers are paying more to retain competent floor staff, and benefits are just structurally more expensive. You can't easily engineer your way out of that.
No, we can't.
But the marketing spend, that 45 basis point jump, that is a conscious, aggressive allocation of capital.
Highly conscious. They are dumping capital into connected TV, Spotify, creator partnerships, and enhanced data analytics.
Interesting.
And the CFO, Thomas Heacock, was very candid about this. He noted they are not just increasing their absolute spend to acquire more guests. The fundamental costs charged by these digital providers are actually rising.
This is the digital customer acquisition cost crisis that we see across the entire retail sector.
Yeah, it's everywhere.
Because 4 years ago, you could reliably arbitrage Instagram or Facebook ads to drive really high-margin discretionary purchases.
Oh, it was so cheap.
It was. But today, with the data privacy changes or just sheer inventory saturation, you are paying 20 26 premium ad rates on connected TV just to maintain your existing traffic flow.
Right, so they are paying vastly more money to acquire a male customer who might only convert on a $30 graphic tee because he refused the premium denim.
Oh man, when you put it like that, it's grim. And that dynamic is unsustainable in the long term. You cannot permanently subsidize a flatlining men's division with increasingly expensive connected TV ads while your store labor costs simultaneously rise.
No, the math eventually breaks.
So how does management plan to outgrow this expense structure? Which I guess brings us to their guidance, or rather the complete lack of it.
Right.
Because Buckle strictly refuses to provide forward-looking sales or EPS targets.
Which is always frustrating as an analyst.
Yeah.
But when management refuses to provide a verbal roadmap, we rely entirely on the CapEx.
Capital expenditures.
Exactly. Capital expenditures tell you exactly what management internally expects to happen over the next 24 months. And Buckle's CapEx profile is highly aggressive.
How much are we talking?
They spent $29.8 million in Q2 alone, bringing their year-to-date total to $44.5 million.
Wow. That is a staggering capital outlay for a company that netted $44 million in profit for the quarter.
Right.
They are essentially reinvesting their entire net income. So where is all that money going?
Well, the primary bucket for this is store expansion and relocation. So they opened 5 new stores and completed 5 remodels this quarter.
Okay, that makes sense.
But the strategy behind the remodels is the real takeaway here. 4 of the 5 were relocations to outdoor shopping centers.
Oh, that is a critical defensive maneuver.
It really is.
Because the foot traffic economics of traditional enclosed B-tier and C-tier malls are just collapsing.
Yeah, nobody wants to go to a dark indoor mall anymore.
Consumers gravitate toward open-air, mixed-use lifestyle centers. So Buckle is actively utilizing their really strong balance sheet to physically extract their stores from dying indoor properties and insert them into these high-traffic outdoor environments.
Which is smart. And they project 5 more new stores and 4 more remodels by year end. So that accounts for $24.4 million of the year-to-date spend.
Okay, but what about the rest? You said $44.5 million total. Where did the other $20.1 million go?
Well, that went to IT and corporate infrastructure, which notoriously included the purchase of a replacement corporate aircraft.
Wait, they bought a plane?
Yes. Replacing a jet that they sold in fiscal 2025.
A literal jet.
A literal jet.
I mean, buying a corporate aircraft when your operating margins are being actively squeezed by store-level labor and health insurance costs is... It's certainly a flex.
It's quite the optic.
Great. I mean, I understand the logistical argument for a company managing 446 stores across 42 states.
Sure. Executives need to travel.
But from an investor optics standpoint, it projects a level of entrenched corporate comfort that clashes directly with a shrinking bottom line.
Well, I think it signals that management is not operating from a defensive crouch. Like they are sitting on $323 million in cash and investments.
Must be nice.
Right. They clearly view the SG&A squeeze as a cyclical hurdle, not some existential threat, which is why they are comfortable deploying capital for corporate infrastructure alongside the store expansion.
Okay, but there is one area where they absolutely should feel an existential threat, and that is footwear.
Oh boy, yes.
Because during the Q&A, an analyst highlighted a metric that is almost hard to believe. And I really pushed back when I read this, like, are they just abandoning the shoe department to pour all their hopes into women's alternative pants?
It kind of feels like it.
Because footwear sales volumes have declined for 50 consecutive months.
Over 4 years of negative volume comps in a primary accessory category.
What's 50 months? And management tried to deflect by pointing out that footwear sales dollars actually increased by 0.5% this quarter.
Right, but the underlying mechanism there is terrible.
Exactly. The only reason revenue went up a fraction of a percent is because the average price point on footwear jumped 10%.
So they're moving significantly less product and relying entirely on price hikes to mask the volume bleed.
Right. And when pressed on this half-decade decline, CEO Dennis Nelson basically blamed the macro environment. He stated they need a strong brand like Hey Dude to drive huge volume and that the business is just, quote, difficult right now.
That response right there exposes a massive structural vulnerability.
Yeah.
Because it is an admission that in the footwear category, Buckle is merely a distributor of other people's lightning in a bottle.
Wow. Yes.
When a viral third-party brand like Hey Dude explodes, Buckle's traffic metrics look incredible. But when that specific trend cools down, they lack the internal design or merchandising engine to manufacture a replacement.
So they are entirely at the mercy of vendor IP.
Entirely.
Which sharply limits their ceiling.
Yeah.
I mean, if you are waiting around for a vendor to hand you the next viral shoe to fix a 4-year volume slump, you are surrendering control of your own floor space.
Exactly. You're just waiting for a miracle. And when we synthesize all of these conflicting signals, right, the massive pricing power in women's apparel versus the stagnant men's segment, the aggressive outdoor mall pivot versus the skyrocketing digital marketing costs, we arrive at our final verdict.
Let's hear it.
For a retail investor looking at BKE, this is a cautiously bullish play, but strictly framed around income and margin defense.
Okay, so break that down. Let us define the bull case first. Why buy BKE today?
If you are buying BKE today, you are buying their private label strategy.
Without question.
Because the sheer inelasticity of the women's segment proves they have a highly captive, highly loyal core demographic.
Right. They bumped average denim prices to $92.50 and still grew volume by 11%. That is immense brand loyalty.
Exactly. But more importantly, private label merchandise now accounts for 44.5% of their total sales.
Almost half the store is their own stuff.
Yes. And when you design and source your own product, you eliminate the vendor markup. It natively insulates your gross margins.
So the fact that male shoppers are rejecting expensive national brands and trading down to Buckles' proprietary denim, that is actually a massive long-term win for the company's structural profitability.
Exactly.
Yeah.
Assuming they can keep the volume up. And they also have the balance sheet to weather almost any storm.
Right, the cash.
Over $300 million in cash, and their inventory is very clean.
Well, wait, inventory is up 13.3% though.
It is, but they are stocking 5 new stores and loading up for back to school. It's highly deliberate capital deployment. It's not just dead stock accumulating in some warehouse.
Okay, that makes sense. But the bear caveats are severe, hence the cautiously bullish.
Definitely. The structural increase in SG&A is the primary threat for anyone considering the stock.
Right. If those expensive Spotify and connected TV ads don't actually reverse the slump in the men's department, those expenses will continue eating into net income.
Exactly. If connected TV and creator acquisition costs continue to compound, and the men's department volume continues to flatline, that marketing spend becomes a permanent anchor on the EPS.
Because you can only raise the price of women's wide leg pants so many times before that elasticity snaps too.
Oh, absolutely. There's a ceiling.
So the ultimate stress test for Buckle over the next 4 quarters is whether their private label margins can outpace the digital advertising treadmill.
Yep. And they have to do it without relying on a $2.5 million tariff refund to artificially inflate their merchandise margins next time.
Good luck with that. Right.
Right.
Well, this leaves us with a pretty compelling final thought for the listener to track, to kind of ponder as we watch the broader retail space this year.
Okay.
We focused heavily on the male shopper's behavior today, specifically that hard line drawn at $89 for denim and the active rejection of premium national brands in favor of Buckle's cheaper in-house private labels.
Yeah, that pivot is fascinating.
So the question is this the canary in the coal mine signaling broader consumer fatigue with big name brand markups?
Oh, that's a great question.
Right, because for the last decade, the dominant mall strategy was to act as an aggregator. You stack your shelves with the hottest national brands and you just ride the coattails of their massive marketing budgets.
But Nike and Levi's do the heavy lifting.
Exactly. But if the middle-class consumer is finally burnt out on the inflation of those logos, Buckle's pivot to a nearly 45% private label business model might be the exact blueprint for how middle-class mall retailers survive the 2026 economy.
I mean, if the average consumer is officially done paying for the logo prestige, the retailers who actually own the manufacturing and the margin might be the only ones left standing.
It's a huge shift, so keep an eye on that private label metric in Q3.
It's the #1 thing to watch.
Absolutely. Well, until next time, keep diving deep.